Hello and welcome to today's Cabot Wealth webinar, 2020 Market Outlook plus 3 stocks to buy now. I'm your host, Chris Preston, Chief Analyst of the Cabot Wealth Daily Advisory and Managing Editor here at Cabot Wealth Network. With me today is Mike Santolo, Chief Analyst of our Cabot Growth Investor and Cabot Top 10 Trader advisories. Today, Mike's here to talk about what he expects from the stock market in the year ahead, how you should approach the currently bullish but possibly a bit frothy investing environment, and what stocks he currently likes. This is an interactive webinar, which means we'll be fielding your questions after Mike's presentation wraps up. So if you have a question, feel free to ask it at any time, and we'll try to get to as many of them as time allows once Mike wraps up. And just keep in mind that we cannot offer advice in regards to your own personal investing situation or portfolio. First, let me introduce Mike. Mike is a growth stock and market timing expert who has been with Cabot for more than 20 years. During that time, his advisories, Cabot Growth Investor and Cabot Top 10 Trader, have routinely beaten the market. Along the way, Mike has developed creative new tools, indicators, and strategies for uncovering some of the market's most exceptional growth stocks. Perhaps most notable was his development of the proprietary trend-following market timing system, Cabot Tides, which has helped his 2 investment advisories place among the top handful of market timing newsletters numerous times. Long story short, Mike knows what he's talking about when it comes to the market and when it comes to finding growth stocks. So I'll let him do just that. Mike, take it away.
Okay, Chris, thank you very much. Thanks everyone for being here. 2020 market outlook. Good start so far for the year. And the good news is we just hop right in. Let's get the slides working here. Yeah, spoiler alert, and you know this, if you've read any of my free stuff or paid stuff the last couple months, I think I'm expecting good things in 2020. I think it's going to be a bull market year, and I think the vast majority of evidence favors that. If you've attended any of the Cabot Wealth Summits in the summer, first of all, if you haven't, you should. It's a great time, a lot of one-on-one time there. But if you have, this is going to kind of follow the same script. I like to look at things sort of starting with the mega trend or the 10,000-foot view, as I call it, drill down into sort of the longer term view, and of course get into the here and now. And what's interesting is we're kind of in the middle innings, in my opinion, of both the key market trends, both the mega trend and sort of the quote unquote regular long term, looking out over the next 6 to 18 months. So those are still supportive. It's not as high odds as it was a year ago. Did a webinar about a year ago, and that was really coming right off the bottom. Very high odds, but obviously I am expecting good things. Right here for the here and now, yeah, we're bullish, but listen, the risks are up. We're watchful. So far, the market's been resilient despite a bunch of bad news really this month, or at least news that could drive the market lower. Really hasn't. But the risks are high that we're going to either get a consolidation, pull back, shake the tree moment, something like that. Okay. But anyway, like I said, I like to start with the mega trend or the secular view. A lot of people call it. You can call it whatever you want. And I'm not going to harp on this too much, but basically over the past 100 years plus years, the market tends to move in these 10 to 20 year cycles. And it's not voodoo or, magical technical chart analysis. It's just during these secular bull markets, which we're in now, you have rising valuations, rising investor perception, and things are usually going pretty good. A lot of new inventions, low interest rates, good policy, that sort of thing. During the secular bears, it's the opposite. And that's when you have your housing bubble crashing, you have your Watergate, you have inflation, you have wars, you have the Great Depression, all those, something's really kind of going wrong in the country and or the world as a whole, okay? The good news, like I said, right now is we're in the middle of one of these uptrends. Now, I yanked this chart off the internet, so I didn't put any of these notations. Feel free to look at it. I think it came from JP Morgan. But long story short, if you look from 29 to 49, the market went nowhere. Okay, from 49 to 66, it basically went up. From 66 to 82 sideways, from 82 to 2000 up. And then we had the 2000 to 2013 period where we made no net progress. Obviously, we had the 2 huge bear markets during that time. And now, or not now, but I guess as of March of this year, we'll be 7 years into the secular bull. Again, these things tend to go 10 to 20 years. It's a very, very big picture background thing. It's not exact. And of course, the market can do whatever it wants to do. But the odds favor that we're just kind of in the middle of this trend, okay? It's not just the charts, though. There's other reasons for thinking that. This is a chart I pulled off. This is from dshort.com. but it's the 15-year annualized return of the S&P after inflation, actually. And it's really just a derivative of the chart we just looked at, but the vertical lines are major multi-year tops in the market. So 1929, 1937, most people don't remember that, but I do, I was there. But that was a 50% decline in the market. The late 60s was a major top, and of course 2000, all right? And you can see, generally speaking, you're kind of in the 12 to 15% annualized return range. Things have been hot for a long time. People's memories of the prior, the mess of the 20 years ago or 15 years ago has been forgotten. We've solved all our problems as a country, that sort of thing. Right now, kind of fitting with the thesis, we're at around, call it 7%, right in the middle. We're not scraping the bottom, but we're not at 15% or anything like that. So we're kind of in the middle range. And I would say now, maybe 6, 7, 8 years from now, that might be different. But at this point, I would say, kind of in the middle of the secular bull. This is a chart, actually, I do update every year for the Cabot Wealth Summit. This is just Gallup asks every year, do you own any stocks? Personally, mutual funds, 401k, anything, all right? And it's just a poll, but it's going back to the late 90s. You can see before the Great Recession, we're kind of in the low to mid 60s percentage-wise. And since the Great Recession, even in recent years, we're kind of in the low to mid 50s. Now, I know some people are going to say demographics and stuff, but first of all, there's nothing that says a retired person can't own a stock mutual fund. So I don't really buy that. I just think the Great Recession did such psychological damage, and it just takes a long time for that to recover and new investors to come in who have a lot shorter memories, that sort of thing. So basically, when, again, 6, 7, 8 years from now, I wouldn't be surprised if this figure is right back up into the mid 60s, that sort of thing, telling you that the proverbial, shoe shine boy is talking about stocks, but we're nowhere close to that yet. And then lastly, on the sort of the secular picture, this is, we have a shorter term indicator in Cabot Growth Investor. It's called the Real Money Index that uses this data. But of course, we also kind of look at the cumulative flow. So this is cumulative money flow into or out of, obviously, all equity funds, equity mutual funds and ETFs. So it's not just mutual funds or anything like that. And you can see, like, even just a couple of years ago when the market was real hot at the end of 2017, early 2018, it doesn't look like much on this chart, but there was 60 or 70 billion dollars gushed into the market right near the top in January 2018, and it kind of hung around the market there for another few months before coming off. The big thing to me is even after the late 2018 was scary, that a lot of people panicked out of it. That's normal. But even 2019, which was a good recovery year, obviously, it had a lot of volatility though. It had a lot of trade war headlines and tweets and all that sort of thing, and uncertainty with the Fed. And people were just withdrawing money hand over fist. Actually, Jacob Mintz, who's the editor of, or analyst, I guess, Cabot Options Trader, I Slack with him most of the day. He sent me something this morning that said 2019 had, I think it was the largest ever, or the largest in a long time, outflows from hedge funds. Okay, this doesn't include that, but the point is that people are still looking for safety. They're going into bonds. And again, that's just not the sort of sentiment you're going to see if we're near sort of a multi-year top. So anyway, I wouldn't wake up every day and say, hey, the secular bull market is intact. It's sort of obvious, but it's good once or twice a year. And when we look out for the outlook for the year, to kind of just keep that in the back of your mind, that the wind is at your back, and all the doom and gloom stories that are out there, or viruses in this case, doesn't mean they can't affect the market, or they won't, but it's unlikely to cause some of these doom and gloom scenarios that people harp on. So then we drill down into the quote unquote regular long-term, the long-term view. The next 6 to 18 months is kind of what I like to say. And I'm not really, I'm talking a lot about cycles and time frames, but I'm not a big cycle guy. I kind of take it day by day, week by week, but it's good to kind of know where you are in the ball game, where you are in the standings. And while a lot of people in the media, in fact, nearly everyone is saying, oh, we're in a 10-year bull market, right, since 2009, I don't believe that at all. In fact, the market's action makes a lot more sense when you consider that, and you'll see this in the next slide, but there's been 2 or 3 sort of cyclical bear markets during that time that have sort of refreshed the advance, led to some new leadership, some new leading industry groups, that sort of thing. And this chart just shows you, not last year, but the fall of 2018, that was a cyclical bear market. When you're in these mega uptrends, the bear markets tend to be short, sharp, and scary. It could be on the extreme side, like at the 87 crash. most of them tend to be more like 20, 25% over 3 or 4 months. And that's what we saw at the end of 2018. And that refreshed the market cycle. And we've seen, I mean, a lot of the names now that people are familiar with, right? Like Coupa and some of the, the Twilio or whatever, those weren't leading, 2 years ago, nobody had heard of those. That's a lot of fresh leadership coming to the fore. Okay, so that kind of reset it. Now we're kind of 1 year into this bull move, 13 months, call it. And these things tend to go, again, it's very general, but these cyclical advances tend to go, 2 to 3 years. Usually the first 2 years are the best. Then the indexes might do okay, but it's kind of choppy and a little bit more defensive oriented stocks. But the first couple of years tend to be pretty good for growth stocks. And that's generally speaking what we've seen, all right? With the secular trend, the mega trend, I said, we're in the middle innings of both. We're probably, and this is way too exact, but we're probably in like the top or bottom of the 5th inning if you kind of want to get into the nitty gritty. I would say, for the cyclical trend, we're probably a little earlier, maybe in the 4th inning. And one of the reasons I say we're earlier is we just recently emerged from the 3rd consolidation since the market bottom in 2009, okay? 2011, 2012, we had 19 months here in the S&P of no net progress. The horizontal line there is a little bit off, but net, the S&P went nowhere from, I think it was March 2011 to November 2012. Then we had the fiscal cliff deal. I don't know if everyone remembers that, and we went nuts. 2015, 2016 was a wear you out bear market. The media won't say that because we're only down 15% on the S&P or whatever. But for 23 months, the S&P made no net progress. The Russell 2000, by the way, went 3 years without any net progress during that time. So that is a bear market and reset the advance. And of course, after the presidential election, the market went nuts. From January 2018 to really through September into early October of last year, again, no net progress. And now we're, 4 months up out of there. Now, as I'm going to talk about, I do think we're a little, there's risk here in the short term. But it would be unusual, not impossible, but highly unusual for something to up and die after 4 strong months on the upside after a 20-month basing period, okay? Probably even better, and this is 6 random charts. I could have showed, maybe not 60, but I could have showed 30 charts easily. There's tons of long-term breakouts. A lot of times, like the S&P might hit a new high. Oh, the S&P is hitting a new high. And then you kind of look at the market, it's like, well, Coca-Cola looks good and, Johnson & Johnson, but there's nothing really confirming the move. Now it's like, chip stocks, biotech stocks. We even see banks, JP Morgan today, by the way, first test of the 50-day moving average since its breakout. Just a lot of, even some software stocks have reemerged. Salesforce.com came out of a, 18-month consolidation or something like that. And when you just see, the breadth of the stocks doing well, different sectors combined with the action of the indexes, again, there's no sure things in the market, but it would just be highly unusual for all these things to do nothing, have a huge shakeout in 2018, chop around, wear everyone out, sentiment's kind of terrible, and then explode higher for 3 or 4 months and then die. So my guess is whether we pull back or not or consolidate sideways, my guess is a lot of these things have more to go. And I actually wrote this just as an aside, not to go on too much of a tangent. I wrote this in last week's Growth Investor, but I was messaging with a hedge fund friend of mine. We were just sort of sharing ideas, and it was just, we were just saying it's really unusual where we have A, so many strong charts, B, by the way, so many persistent charts that are just up, 8, 9, 10 weeks in a row or something like that, which is a sign of persistent accumulation by big funds. And they look relatively early in their advances, meaning they just got going from these 1 or 2 year ranges. So I think that is really one of the big bullish pillars that are out there. All right. This is a little bit of a busy slide. If you want to know the details on these, shoot me an email. I can put together a little, half-page thing. But basically, there's just a lot of these long-term studies. The market did XYZ over ABC, and that's only happened 10 times in the last 40 years. What happened those 10 times? Did the market go up? And it turns out there's just a lot of things that have happened over the past 5 to 6 months, I'd say, some of them more recently, that portend, good things down the road. It's basically just telling you it's a bull market. I mean, that's basically what it was telling you. The last one here, I'll just mention that I call it the similar study. I couldn't come up with a good name for it. But basically, the other day, I think it was last week, I just said, oh, the S&P is up, 13% in the last, 72 days. It was something stupid like that. But I just went back and looked. I said, hey, since 1980, what do other occurrences like this, look like? And sure enough, 6 months later, even though the market's had a huge run on average, it's up another 8%, that sort of thing. So that's where those targets come from. It's, hey, the market should be up 15% a year later. So I'm not trading based on those. I wouldn't advise you to memorize those. It's just when you see not just one or two, but 3, 4, 5 studies all point in the same direction, it just gives you more confidence, just putting more odds in your favor that, like I said, it's a bull market and we're probably going higher here down the road in 2020. These charts were over the weekend, so I know they got a little bit of virus, not to make a joke of it, but they pulled back a little bit. But there's been no divergences lately. Again, when you're looking at the long-term view, usually you see at least like a month worth of divergences, if not 3, 4, 5 months. Like before the 2018 decline, the AD line diverged from the S&P, I think for about 5 or 6 weeks. But as of this weekend, and I think as of Tuesday or Wednesday, to be honest with you, there's no divergences going on. Small caps, mid caps, AD line, that sort of thing. So things are generally speaking in gear. And then, for sentiment, I think this is the last slide on the long term. This is a secondary indicator, but it's interesting. I don't know anyone who trades the RIDEX funds anymore. They're leveraged long index or sector funds, and you can do that via ETF now. But interestingly, the asset levels that they have tend to correlate pretty well here. You can just kind of line them up here with the S&P chart, pretty well with tops and bottoms over the past few years. So I keep an eye on it, and you can just see sentiment has been heating up a little bit. Some of the money's come in. This is a 21-day moving average, so it's a little bit higher than that in real life. But, we're nowhere near where we were during, say, the spike peak of January 2018, when it was up at $4.7 billion or whatever, or even the highs there in 2015 when the market was sort of topping out, okay? So sentiment is heating up, and I'm going to show you some shorter-term sentiment things that are a little bit more yellow flags. But in terms of, people putting money to work and people really being greedy, it's just not there yet. So I think, again, the secular trend and the longer term trend, they're both in the bull's favor right now. And that's really, honestly, 80% of the ballgame. Now, I come to work every day. I'm looking at the market. We look at charts, and I mean, things are extended. So, now we don't sell, thankfully, we don't sell because of that. I really wouldn't, by the way, if you're obsessed with overbought, oversold stuff, I would try to get out of that habit, because it's going to work against you, or it's going to work for you a few times in a row, and then you're going to miss a really big trend. So things have been sort of overbought since mid-December, but you never want to sell because of that. We are getting stretched here. This chart is the S&P versus its 35-week moving average. Mike, why are you using a 35-week moving average? That's just what we use in our Cabot trend lines, which is our long-term trend model. It's probably our most reliable market timing indicator, but one of the key ones we watch. And you can just see, this is just going back 10 years. I just pulled it right off the spreadsheet that we keep. And I think it closed last week 10.5% or whatever that number is. You can see it's not up there very often over 10%. Now, some of these things ended up being the start of multi-month consolidations. Some did not. In fact, one was in early 2013. That was I wouldn't say a great time to buy that second, but the market had a great year that year. So I don't think it's a longer term negative. In fact, if anything, I think that sort of momentum we have is a longer term positive, but there's no question that we could pull back a few percent or chop sideways, and it would be totally normal within the bigger scheme of things. And then here's, this is shorter term sentiment. So we've looked at sort of cumulative money flows right early on, and you're seeing people are just piling out of it. We kind of looked at what I would call speculative money flows with those RIDEX funds, and they were, perking up, but nothing, kind of in the middle of the range, nothing extreme, nothing that would point to, a 9-month consolidation or something long. But shorter term, this is like a 10-day moving average of the equity put call ratio. Low means there's a lot of calls and there's not a lot of puts. What does that mean? Nobody's really buying protection. That's what it means. Forget about betting on a market decline. People aren't really betting, trying to protect their portfolios. They're not really nervous, that sort of thing, which is good, and it can remain good until it isn't, sort of thing. So you just know the environment's there where if things start to kind of come down here in the short term, there's probably going to be a lot of people who are saying, hey, I got a lot of profits here. I want to protect. I'm going to trim some stocks. I'm going to buy, puts or whatever to protect myself. The chart on the right is the AAII survey. It's bulls less bears. It's a 4-week moving average. Again, it's kind of interesting, like the Ridex thing. Just to go on a note, only 300 people or something answer the survey, so you'd think it would have no value, but it does line up pretty well with tops and bottoms, okay, with the market. And you're going to see, again, this chart goes back 3 or 4 years. It's toward the higher end of the range. There's no, I don't use it for signals, or there's no buy or sell signals per se, but, people have gotten the message that, hey, the market's pretty good. We're hitting new highs. A lot of the worries of the past few months, the trade war, and even stuff that popped up this month, like Iran, seemed to have kind of came and gone pretty quickly. So this just tells you that there's a rising risk of a retreat, pullback, shakeout, whatever term you want to use. You just have to be aware of it. So you want to be choosy on the buy side. And that's really it. So summary, the big picture backdrop, the mega trend remains very supportive. All right. Again, you're not going to wake up every day and say that, hey, the secular bull market's up and that means I got to be buying stocks. No, but like I said, once or twice a year, you want to just be aware that, hey, the worst case scenario, especially if we do pull back and, unfortunately, say this virus spreads or some bad stuff happens in the world, these things tend to happen. You just want to keep a level head and say, oh, this time is different. Now, chances are we might pull back, we might correct, but chances are that pullback is going to be viable and eventually lead to higher prices, okay? In terms of the current bull run, yeah, I think we're kind of in if you look at the fact that we're 13 months into it, it's probably something like, we're in the 5th inning, but I think the fact that we just came out of that 20-month range in the S&P bodes well for going down the road, okay? And there is a near-term risk of a shakeout and a rest, okay? But the good news, and like I pointed out on that slide, I think one of the biggest positive pieces of evidence is there's tons of stocks that are early-ish in new uptrends, what should be sustained uptrends that last many, many months, okay? And that includes the 3 picks I have for the year. Now, I could have, as we get into the stocks here, I could have just picked 3 stocks from Cabot Growth Investors model portfolio, but I thought it'd be a little bit more fun. I picked one. I wanted to focus on liquid leaders, first of all, which are big, well-traded, institutional quality stocks, okay, that tend to not just do well, but are easier to hold on to. So they're not bottle rockets like, say, a Luckin Coffee, which I like, but that thing can come up and come down 20%, right quick. They're a little harder to hang on to, especially if you don't have a profit. These other ones tend to act a little bit more like they quote unquote should and respect areas that they should if all goes well, okay? So without further ado, let's jump in. Okay, pick number 1, and this is in no particular order, but this one I do own. We've owned it in Growth Investor for a couple months. This is Dexcom, DXCM. And I like to analyze things, if you don't know my work. Story, numbers, and chart are kind of the 3 pillars of what we look at when choosing individual stocks. Now they have I think they have the best, in class continuous glucose monitor, which is big. But I think that the really even bigger story is that the whole diabetics field and the insulin field, so to speak, is really shifting thanks to technology. More and more people are getting on pumps. They're using these continuous glucose monitors. They have much better results. Now, my grandmother-in-law, I guess that's the right term, she's 90 years old. She's not going to start using a pump. She has diabetes. But, I've seen kids at the beach, unfortunately, they're diabetic, but they have, a Dexcom G6 or a pump that uses a Dexcom G6 in there. And I just think it's going to become more and more as the technology gets better and better, leaving behind sort of the finger sticks, not sticking yourself 10 times a day to take your own readings. The company itself has been doing great for the last few years. You can see sales are up, 2.5-fold, and the last few quarters, 30+% sales and earnings growth. But the stock really, it had a big comeback in 2018. And then the market fell late that year. And you can just see it tried, let me try to see if you can use this. It pulled back, not too bad really with the market. It really didn't fall off a cliff or anything, but you can just see it had a lot of failures, okay? Because I was watching it for months. It tried to get going here. No, the market wasn't ready. It fell back down. Oh, no, that's a good reaction. I think they had a good outlook for 2019 here. Oh, it looks like a breakout. No, guys, nope, that got hit again. And then, okay, no, this one's for real. No, that didn't work. Okay, now this is definitely for real. No, that didn't. So it just really wore people out with a lot of ups and downs. So then when the time, I'm sorry about that, when the time came to get going, it did. It broke out in early November on earnings, and it really had that power on the breakout with the volume and the big gain. It wasn't, it was very decisive. Since then, it's held the blue line is the 10-week moving average. It's respected that. As we always say, if something really changes, I can always be wrong. We'll sell the stock and move on. But I really think that it spent 14 months doing nothing. It broke out. It's acting well so far. It's had a couple of shakeouts, and I think it's a liquid leader of this advance. I think it can do very well. And they also have a new product coming out, their G7, later this year, which I think just in a bull market can cause a lot of enthusiasm as it greatly expands their market into some type 2 patients. So anyway, Dexcom is one I'm high on, DXCM, I think it acts well, and the path of least resistance is up. Pick 2 is not going to be a stock that no one's heard of. Everyone's heard of this one, Tesla. Very controversial. Somebody said it best, it's like politics. You kind of love them or hate them. I honestly have never, I've been sick of hearing about them the last few years because I've never seen a stock have so much press coverage when it really did nothing for 6 years, which is what it did. But the big story here is just really demand has never been an issue. And despite all the well-deserved criticisms they've had as a company, they haven't ever, they've been selling as many cars as they can, as many as they can produce. And they're really bringing I probably shouldn't have said masses here. They're bringing the electric vehicles, maybe not to the masses, but it's not to the 0.1% anymore. It's probably to the top 10%. You can get a car for 40 grand, 45 grand if you want, stylish, performs well and all that sort of thing. The numbers that we're keying off here, I think, going forward is the 2020 earnings estimates. They had one big quarter in Q3. Then it was like, oh, they might make $3 or $4 in 2020. Then the estimate became $5.50. Now it's up to $6.50. Now, who knows? You can never put anything past them. So who knows how they executed in Q4? But I think as long as that perception keeps growing, that 2020, and of course, going forward, 2021 going forward with the Cybertruck and all that is going to really goose earnings. That's kind of brought a lot of institutions back into the fold here. Okay, now the stock, I'm not ignorant to the fact that the stock has gone bananas here recently. It's more than doubled over the past few months. So obviously it could take a month or 2, 3 months, who knows, to build a base at some point when it tops out. But I'm looking at this whole thing the last few months as the initial breakout. Again, you have these stocks that haven't gone anywhere for 4, 5, 6 years. Anyone except the ultimate true believers like Tim have sold out. And now obviously there's a lot of hot money in there short term. But if you're an institution, you're kind of like, all right, there's probably hundreds of institutions trying to rebuild positions that either they trimmed or they got rid of. And that's going to take time. It doesn't just all happen in 6, 7, 8 weeks. Okay, so I still think it's early stage. It's a long way of saying that. And I love the accelerating price and volume. It's not something I'm buying here. And of course, this chart was over the weekend. So now, of course, the stock's up another 30 or 40 bucks. But I do think if you get, it won't take long, it doesn't have to be 3 months, but if it pulls back for 2, 3, 4 weeks, maybe the first test of the 10-week moving average, see how it's acting, see what the market's doing. Like the market as a whole, I think the first pullback consolidation will prove viable. It might take a little bit longer than people want once it starts pulling back, but I don't think it would be highly unusual for it to just top out here. And last but not least is a stock that I would say is the top of my watch list right now, believe it or not, Alibaba. Obviously, it's been pulling back here with the virus stuff. So, we'll see how that goes. But I wrote about this in last week's issue of Growth Investor. Obviously, it's still the blue chip play in China. They have some stuff besides retail, like their cloud computing could be like the next Amazon Web Services over in China. And I wrote that I think basic conditions have turned up. China stocks had a huge 2017. We owned Baba back then, and we made some good money, but I was kind of disappointed because I really thought it was starting what could have been a 2 or 3 year advance sort of thing, kind of like Baidu did back in 09, 10, and 2011. We rode that. But then it got interrupted. Why? Well, the trade war. You can't ignore that. And the trade war just got worse and worse, a lot of uncertainties. And you can see even through most of 2019, the stock was just kind of stuck in the mud. Okay, but it broke out around 190, and it's been very persistent since then, up, I don't know I guess it says 9 weeks and 12 out of 13 coming into this week. All-time highs, which is better than most Chinese stocks. And I think it's almost resuming the leadership role it had from back in 2017. Now that, at least for the next few quarters, probably, right? Basic conditions in terms of the trade war and stuff have changed for China, promising, their economy is probably going to reaccelerate. This company's been doing great the whole time. I think maybe better currency action is going to sort of help translate numbers. I don't want to get in the weeds on that, but they've got 60 billion in revenue. They're still growing at 30% plus clips. And I think the macro is going to help. So I think Alibaba, it's not something I think is going to hit $400 in the next 2 or 3 months, nothing like that. But again, it's a liquid leader, I believe. I think, again, like Tesla, a lot of big investors got out, they trimmed. Now they're getting back in, they're building positions. And if they come out with a couple, a good quarter here in the next couple of weeks, I really think the stock can trend nicely here throughout the year. So those are the 3 picks. Of course, there's a million strong stocks out there. We own other stocks that I like too, Corvo and all these other things. So it's not just these 3, but these are 3 liquid leaders, including 2 I don't own that I'd like to own. And I would say Alibaba is, like I said, probably on the top of my watch list right now. So that's it for, I believe, the presentation. So I'm going to hand this over to Chris, who's going to tell you about a special offer. And then when he's done and I get a sip of water, I'm happy to answer any and all questions you guys have.
Yeah, thanks, Mike. Like Mike said, I'm going to give him a minute to catch his breath before he starts answering some of your questions. I see we have a few rolling in. In the meantime, just a bit of housekeeping. If you like what you've heard from Mike so far today and are interested in signing up for his Cabot Growth Investor Advisory, which is our flagship investment advisory here at Cabot, dating back 50 years since our inception when it was called the Cabot Market Letter. We have a special offer reserved exclusively for today's listeners. You get the first 30 days for just $1. In essence, a free trial run to see if Growth Investor is right for you. And when you subscribe, what you get is immediate access to Mike's exclusive growth stock portfolio, twice monthly issues, weekly updates and special alerts, Mike's guide to investing in growth stocks, and direct access to Mike for any questions you might have. Now, to subscribe, just go to the website on your screen, cabotwealth.com/webinar special. Again, it's just $1 for the first 30 days. Now let's get to your questions. Let's see. Here's a pretty good one from Decibel. Hopefully I'm pronouncing that right. Is it a good time now to buy the S&P 500, Apple, Nvidia, and Twilio, or should I wait for dips? What month do you think the market may dip, and to what level would be a good buy?
Well, if I knew that, I'd be on my yacht right now. I would say, generally speaking, I think it depends. I don't want to make too much of an answer, but I think a lot depends on where you are in your portfolio. Okay, if you're kind of missed out, if you're half in cash, just to pick a random number, yeah, I'm okay buying a couple small positions. You know what I'm saying? And trying to force feed your way into it. And while I do think the market could pull back, I'm not anticipating, like a 20% decline or something crazy in the market. So I'm fine doing that, whether it's the S&P 500 or whatever other index. That said, if you're already heavily invested or even on margin, I wouldn't be pushing the envelope right here with some of these stocks. I think they look great. I'm just flipping through the charts right now. Apple's had a huge run. Nvidia and chip stocks look great. So if you really wanted to buy a small amount, that's fine. But I'd kind of lean toward keeping it small and or looking for dips and shakeouts on some of these names. And if they don't pull back and shake out, well, then hopefully all the other things that you bought and own are going to continue higher and you're going to do fine. That's kind of where I'm at right now, is just being a little choosier on the buy side. I do think those stocks look good, but there's nothing that says they can't consolidate for a bit.
Here's a question from Carol, who's been waiting patiently. Do you have any suggestions or advice on Bitcoin?
I don't. I keep a very, very, very distant eye on it. Usually when I just see some headlines, GBTC is sort of that fund that owns Bitcoin, but it's just kind of stuck in the mud here. It's not something I would play anyway. I'm a growth stock guy. But even just looking at chart wise, even if I didn't know what it was, there's no momentum there. It's not strong. It's trying to bottom out, but there's nothing doing at this time.
Okay. Let's see here. Jerome asked for your thoughts, Mike, on, well, you mentioned Corvo, it's one of the stocks, but Docu and Okta.
You mean DocuSign?
DocuSign, yeah, DOC.
Yeah.
Yep.
Yeah, DocuSign, I like it. I love the story. I think it's got the fundamentals I love. I think it's rapid, reliable, and a long runway. I'm trying to come up with a cool moniker like 3Rs or something for growth. That's really because that's what institutions want, right? They don't want to buy something that's going to blow up, take a big position, something's going to blow up next quarter. So fundamentally, I really like it. I have to say the stock hasn't really been a leader though since the market got going in October. The stock hasn't done anything wrong. It's kind of riding its 50-day line higher, but there's not a lot of power. I do have it rated buy, so I'm certainly holding it. But I'm keeping an eye on it. If you have a profit, I would just hold tight. And if you want to nibble at it here, that's fine. But I wouldn't say it's the strongest horse out there. Okta, some of the software stuff has gotten going. And I have to say Okta has formed a decent base right here, meaning a launching pad the last few months. The only thing we're 4 months into the advance. If you haven't broken out yet, maybe you're not really a leader. Now, I'm not saying that Okta can't go up or can't do well, but I'm sort of preferring stocks like, say, Alibaba that's already broken out, already trended higher, and now you're trying to play that next pullback or consolidation or whatever happens. So Okta is okay. I'm kind of neutral on it. I do think short term it is set up pretty well here, but I'm just not sure. To be honest with you, a lot of these cloud software stocks, they look better, but they're not. I don't know. They've had they're up, 5-fold in the past couple of years. You're not in the first inning there.
Okay. Let's see. Plenty of questions about specific stocks rolling in. One from Mike. Any thoughts on Costco with new stores opening in China?
I don't have any deep thought. It's been one of the better acting, especially recently, but even the last few months before this consolidation, it was one of the better acting sort of mega cap retailers, for lack of a better term, $130 billion market cap. And it is just kind of breaking out to new highs here this week. So I'll give it a stamp of approval. It's not my kind of name. It's not growing fast enough, but I certainly don't have anything against it.
Okay, Jason is asking about Advanced Micro Devices, AMD. Well, just generally, what are your thoughts?
Yeah, AMD is, I like it. I think it's a leader. It was one of those charts, I think it was one of those charts on the slide that had the long-term breakouts. I'm looking at a chart here.
Up 20%, he mentions.
He's up 20%.
In the last month, yeah.
Yeah, well, all I'll say is the stock had one of these, it didn't do anything for a year sort of thing. And then since the market bottom, I think it had, I'm looking at a chart here, I can't count them all, 12 or 13 weeks up in a row. And of course, before it had a down week. When you get that many weeks up in a row, which by the way is kind of what we've seen with the overall market, again, it's a sign of persistent accumulation. Doesn't guarantee anything, but it's a good sign that, especially if you're early in an advance after a breakout, that it's going to carry forward. So AMD I like. Again, I personally would prefer dips or consolidations. If you want to try to shoehorn your way into it, start small, that's fine too. But long story short, I do think it's one of the, 10 liquid leaders out there. Okay.
Another question from Carol. Any suggestions on marijuana stocks?
That's a good question. I'm intrigued. They've had a big decline. They're nothing I'm going to touch here because they are still in longer term downtrends. And I'm a trend follower, so I don't go there. But I'm also a chart reader, and there's been a lot of big volume buying in some of the names. I keep an eye on CGC, which is to me just kind of the blue chip of the group. Not that it's a blue chip, but that sort of thing. And that one's had, first of all, they've been bottoming out for 2 or 3 months. They might need a longer bottom given that they got, destroyed, more time. But there's been a lot of good volume clues in that starting in mid-November. And just recently, of course, it popped higher. I'm going to leave the official advice to Tim. He's much closer to the stocks. He's done a great job of sort of timing them. But I do think that there's increasing signs that the decline they have is the worst is behind them. I guess I'd put it that way. Whether they get going from here or need a little bit more time, I'm not sure, but I think there's a lot of potential there.
And Mike, you mentioned Tim. That's Tim Lutz, who's our CEO and is chief analyst of advisor we have called Cabot Marijuana Investor, which he's managed to his positions are well up despite the decline. So in case you're interested, he's definitely the person to go to on marijuana stocks. Let's see. Another question from Decibel. What is your take on cloud computing? What companies do you like?
Well, the cloud software stocks have all reemerged. Story-wise, I still love Coupa. I just have a soft spot for it. I think it's got emerging blue chip written on it in terms of all these companies using its, I guess they call it business spend management, That said, I wouldn't say it's a lot of these, they don't strike me as super powerful here. They've had either big runs sort of off their bottom this year in 2020, or Coupa did break out to new highs, but it was good, not great. To be honest with you, chart-wise, the best looking one, believe it or not, is Salesforce. I know that's sort of bigger and not slow, but slower. So I'm not going to argue with it. The group seems to have reemerged. I'm just a little bit more preferential to, like I said, some of these earlier stage stocks that just broke out of 2-year bases a few months ago, as opposed to things that broke out back in February, March 2018, had huge runs, and now are kind of participating. Don't get me wrong, if Coupa, say, reacted well to earnings or started showing some power, I might take a swing at it. But my focus is mostly elsewhere at this time.
Here's a question from Ricky. You may have touched on this or touched on this a little bit earlier, but at what level would you consider taking an initial position in Tesla?
Yeah, it's a good question, and I don't have a good answer for you. The reason, I could just say, a pullback to the 25-day moving average, which currently is 470 or so. But honestly, it's really going to depend how it pulls back, how it consolidates, and stuff like that. At some point, it's going to meet up with its 10-week moving average, which is just kind of what these things do. I don't know when. And so when it does, I'll be ready. If I miss it, I miss it. We got some other good winners, and there's some other stocks I think I could buy, on pullbacks if Tesla doesn't. That's what happens. But it's not so much a level, like a value. It's more of how it progresses here in the next few weeks or a couple weeks.
Okay. Question from Jabir. Can Snap still be considered a leader? Do you have any thoughts on this stock?
Well, it's a good question. I like Snap. It's kind of, I'm not sure it's going to be on my watch list and my update tonight, but it's something I am watching again. I don't think the story has changed at all. We took a swing at it last year and it didn't work out. But now it's kind of reemerged. The trick here is they got earnings. They might be this week. They might be tonight. I forget. It's pretty soon. So they got earnings the next few days. That's probably going to tell the intermediate term tail. But I do like the persistency of the advance. It's kind of reemerging. And this one got killed for the prior couple of years before last year, so I don't consider it overplayed at all. So I do like Snap. It's something that I wouldn't mind owning. I don't really see, I'm not going to jump into it ahead of earnings though.
It looks like earnings are on the February 4th. So
okay.
What I have here. Yeah, so coming up.
Couple weeks then.
Yeah. Let's see. Do you have any, question from Craig, do you have any cybersecurity favorites?
Not really. Again, this was kind of a group that some might reemerge, like Okta obviously is in that group. CYBR was a leader last year. That's trying to sort of reemerge. But I'm sort of putting some of these in that category of like the cloud computing names that were, I'm not trying to sound bearish on them at all. I think they could do fine, just fine. But they've had big runs and they're kind of more obvious to the crowd than some of the other names that have gotten going. So I don't have any favorites right now. We're more bottoms up than top down anyway. But if something really emerges and earnings season's coming up, always, kind of can change the landscape. But right here, not so much.
Okay. Let's see here. Lots of questions. Another question from Ricky. Disney had a big breakout last year, but the price action has been weak since that big breakout. Any thought on what's going on with Disney?
Yeah, it's been disappointing. I mean, not that it's too big for me, but I guess what I would say is when you're looking at the, big picture, I still think it's intact. It hasn't done anything that's out of the ordinary for it. It's above its 200-day line, which is slow, but that's kind of what, a stock like Disney is going to do. But I agree that I kind of thought it might be ready to get moving there in November when the Disney Plus, the big volume clues. If you own it, I assume you don't have a huge loss. It's only 7% off its high. If you own it, I would probably give it a chance here. But my guess is it will come down to earnings and the updates on Disney Plus that they give and the outlook and stuff like that. If it can emerge on that, I think it's got a chance to do pretty well. If not, then not. Right here, it's not a leader, but not broken either.
Yeah, that was my stock pick for the year. I hope it does well.
Well, then it's definitely going to do well. It's guaranteed. So.
Yeah. Let's see. This is an interesting one. I think I know what your answer might be, but a question from William. GE, General Electric.
Oh boy.
A recommendation has it or is forecasting it to rise to 14. I guess just what are your thoughts on GE?
Right. So my main thought is I don't follow it closely and all that. Yeah. It's not my kind of stock. I will say it's gone through the ringer. Obviously, it's bottomed out for a long time in sort of the 6 to 8 area, and more recently it has tightened up, which is usually a sign that I guess I would just say the weaker hands are out. It's under control, so to speak. So just chart-wise, and it's a bull market overall. So it would not surprise me if GE could get to $14 at all. It's $12 right now. That said, I don't have any insight or, don't know what the prospects of all their businesses are, stuff like that. So not something I'm that close to, but, my guess is it could head higher.
Yeah, Krista Hoff, who runs our value investing advisory, she's even been saying stay away. So
right.
That probably says a lot. Okay. Question from Stan, who's been waiting patiently. How do you compare Qorvo with SWKS? That's Skyworks Solutions.
Right. They're very similar, to answer your question. In terms of in my opinion, investor perception, which is what's going to drive the stocks, they're both basically plays on, the 5G smartphone move. So, when I see QRVOs down 2% one day, and I don't know, I kind of check Skyworks just to see like, hey, is this something that just is sort of a group thing or not? I think they're probably as close of peers as you can get in that space. And I think both do well. Skyworks was a little bit stronger recently. Qorvo obviously had a bigger, I call it Qorvo just for fun, but it had a bigger run after earnings and all that. So, but they're both, two sides of the same coin, I think, in terms of investor perception.
Okay, I think we have time for a couple more. Let's see, a question from Henrik. Is Shopify too high to buy right now?
Good question. I hesitate to say it's too high to buy because you could have said that a month ago and all that. But that said, yeah, the stock's from 320 to 480, almost 470 in the last few weeks. It is out to new highs. You're going to have earnings coming up in 2 or 3 weeks. So if you want to start, it's kind of the blanket answer. If you want to start with a small position, see what happens and try to shoehorn your way into a bigger position over time, I think that's fine. But in terms of a big position, at least the way we operate, I'd probably hold off.
Okay. Question from Ajay. Any thoughts on AYX?
Yeah. So this is one of the cloud software. It's the almost a new big data stock, I guess is, it's one of the same thing. It had a huge run. It fell from 150 to 100 basically. It bottomed out for a while. And since the calendar has flipped, it's really come on strong. I got nothing against it, but there's still old overhead. I'm just more neutral on it. If I owned it, I'd hold on for sure. It's shown great power so far this year. and maybe it's definitively turned the corner and it's going to go much higher. The story's still good. The growth is still good. So I'm not doubting it. But in terms of just plowing in right here, I'm not sure I'd do that. My guess is it, probably goes a little higher, but then, needs to pull back and consolidate, especially as earnings season gets going here.
All right. Let's see, one or two more. Paul asked your opinion on Teladoc, TDOC.
Well, obviously I like it. We own it. What's interesting is it just this week, or last week, I guess, broke out finally of this huge 15-month consolidation it was in. And it's carried forward a little higher here. It's around $100, a little higher than 100. It's definitely a story stock. They're losing money, but the growth is there. And what I kind of always liked about it was it's attracted a lot of funds. So even though it's lost money and, virtual care, telehealth, it's not the most common. It's not something that you can touch very easily, But as of the end of September, 615 funds own shares, mutual funds, which is a pretty good number, and that's a good sign to me. So the bottom line is I like it. Like everything else on the planet, it could pull back. I mean, it's extended, but it's strong. The volume clue a couple of weeks ago was for real, so I'm optimistic.
Here's a good question to end on from Jason. It relates to something you just wrote about for tomorrow. Mike, could you give us some advice on how to set an appropriate stop loss for a stock and what to watch in the charts?
Right. So definitely I don't want to read the whole Cabot Wealth Daily from tomorrow. So if you're on the list, if you're not on the list, get on the list. If you're on the list, it'll be shot out tomorrow morning, Chris, I think.
Yes, first thing tomorrow morning. Yep.
But basically, I provide a bunch of tidbits in there. It's really half the battle is what you want out of the stock. So, I mean, if you're okay selling something or getting knocked out, but making good money, even if the stock keeps going higher, you're going to handle things differently than if you're really trying to develop some bigger winners. Me personally, which is all I can really tell you about, we tend to do kind of a tight to loose system where, when we buy something, it's relatively tight stops, meaning 10 to 12%, generally speaking. It depends on the stock, how volatile it is, as a loss limit. And then as you start to make progress on the way up, especially if you take some partial profits off, say you're up 20, 30, 40%, you take a little bit off the table, then you kind of loosen it up. If you think you're in like some of these stocks I mentioned, Dexcom or whatever, you try to loosen up the stop a little bit and play out what could be a longer term move. Now, if you've been playing that longer term move for a year and a half already, maybe you're thinking, it's not going to go on for another year and a half. But at this point, if you think you have one of those leaders, I would tend to consider selling some shares, not half, but maybe less than half, and then trailing sort of a looser and looser stop and try to, develop some of these winners. Because a lot of these stocks I think could be a lot higher, 6 to 9 months from now. There's definitely going to be corrections along the way and painful, downgrades and earnings disappointments and stuff like that in between. But that's kind of how we're doing it, what I'm aiming to do with some of our winners here that we have already.
And like Mike said, you can, if you're a Cabot Wealth Daily subscriber, that's our free newsletter. You'll get that in the morning, or you can go to the cabotwealth.com website tomorrow. It'll be up there. Okay, we'll go ahead and wrap things up there. Very good questions today. Thanks for all the questions. And thank you, Mike, for hanging in there. So thanks for joining us. And Mike will actually be back next month with another free webinar on February 26th at 2 p.m. Eastern again, to give you 5 more growth stocks to buy for March. We'll almost be in March by then. So mark that on your calendar. That does it for us. For Mike Santolo and the entire Cabot Wealth Network team, I'm Chris Preston. See you next time.
Yeah.